Hi, you guys. Been a while since I came. I hope you're enjoying your stay here in this group. Anyway, I wanted to come up, jump in rather real quick because there's something's going on in the market, and a lot of us and a lot of you, I also assume, are really looking to buying a property for own stay, and at the same time, a bit hesitant and not so sure what to do. The resale market has been very active this quarter, and I'm sure it's going to be as active in the third quarter results when it's being released. And I wanted to, at least for those of you who are insistent that you need to buy a property for own stay, what you should be looking out for, and then you're able to strategize that accordingly. Okay, right? So let me just share with you this real quick. Right. Okay, so basically, what you see in front of you will be the historical chart of SIBOR and SORA, right? And just to give you some indicative, back in 07, the one month SIBOR was at 2.5. The 3 month SORA was at 2.28. That was in 07, right? It came down because of the Great Recession. And I think for the longest time, a lot of us will had the mindset rather that these low rates from 09 all the way until perhaps in 17 was the norm. A lot of us would enjoy below 1% interest rates, right? And we were all really happy about it. And it's gone up significantly based on back in 2019, if you can still recall, right? And you see my other videos, I did speak about that a little bit. And then because of COVID, it came down. And now, again, because of all the other issues we are facing right now, it has jumped back right up. Okay, so this is very significant. In fact, it's even higher today. This is back in July 2022. Yep. And I wanted to be able to at least prepare you guys with the numbers and the cash flow, especially on if you want to buy a property for own stay, where is that money going to, and how you can better prepare yourself. Okay. Yeah. So previously, this is an example that I did up is basing on a property of $2 million. Yeah. And for a $2 million, you have to have a down payment of $500,000 and taking on a principal of 1.5 million, right? Now, if you base in the past at a 1% for a 30 years loan, it would mean that your monthly mortgage was about 4,800 plus minus. Yep. For a 30-year loan, the total interest that you paid is really low at 200 over $1,000. Yeah. And if you look in when we amortize this for the next 30 years, you can see that every year you'll be paying close to $58,000, and of which most of your monthly payments that you're paying goes into your principal. A very small amount goes into your interest, and because for every mortgage loan, this is a reducing balance interest, right? So you can see that over the years, this amount will drop and this amount will go up. All right. And in 30 years' time, it would then mean that of all the payments that you have made of 1.7 million, yeah, only 13.6% goes to your interest. Now, this is what I have spoken about, and I wanted to at least highlight this to you. Interest rate, I believe, will continue going up, right? At least for the next 2 or 3 quarters. I believe so. If you look at the papers, you see inflation in the different parts of the world is extremely high. And this is what UOB has actually forecasted, right? By third quarter this year, SORA should have hit 1.53. Today, SORA, today's date, right, is based as at 1.579. And if in the event it does creep up to close to 3%, then what does it mean to all of us? Yeah. So if I were to give you an example based on the same $2 million property, right, borrowing at 1.5 and the same 30 years of loan period at 3.5%, you can see that the interest rate has jumped significantly higher, right? And so has your mortgage payments. You paid about $4,008 in the past. Now you pay about $2,000 more for the same quantum. Yeah. But the scary thing is actually this table over here. It tells you where does your money go to every month, every year. All right. And you can see that for the first few years, most of your money actually goes to the bank. It's the bank's profits. Okay. For the first year, more than 60% goes to the bank. You have in total, you have paid $80,000, but only 28,000 goes to repaying back your loan, which is your principal. Okay. So I'm assuming that you guys know all these jargons already by now, right? And moving forward, you can see that it more or less it only starts to even out, right? 10 years later, where it is 50% goes to your loan and 50% goes to your principal. All right. So this would mean that your cost of housing has gone up really high. Yeah. And if you hold on to this property at this interest rate, and if it does really take us up, we enjoyed such a long period of low interest rate, right? So who is to say, or we have to, that it might not happen, at least in the next few years? What if interest rate remain at this rate for a prolonged period of time, 4 to 5 years? Then you got to then be able to be prepared for it, isn't it? So in 30 years, instead of the previous slide that you saw, now 38% goes to your payments. Yeah. And I think for all of you, I've been trying very hard to advise all of us, to, as far as possible, finance your property in cash. But for those of you who are still in the belief that I want to hold to more cash, especially today when inflation rate is high and you need extra cash to make payments for your car petrol, buying a new car, I don't know, or whatever expenses that you have, and you still choose to use CPF, let me just give you this example. So this example is if you held on to this property for 8 years, paying $6,000 a month, right? I'm just giving you a calculation. What is your break-even point 8 years later? Okay, break-even point, what does it mean? It will mean whatever you sell for, the amount is to be paid off to your loan, and all the other monies has to go back to your CPF, what you have used so far. Yeah. So in 8 years, your loan will have a balance of about $1.238 million. And you can see, based on a $2 million purchase, you have used your CPF. If you have paid 20% in CPF, and you also choose to pay your stamp duties using your CPF, all right, you have utilized about $464,000. Yep. And if you use this on a monthly calculation for the next 8 years, it will mean that in total, you have utilized about 1.11 million in your CPF over the course of 8 years, plus the initial, of course. And your total accrued interest that you will have otherwise earned from CPF by you leaving your CPF in the CPF account is $171,000. So in total, you have to return $1.282 million back to your CPF. Okay? This would mean that in 8 years, when you buy a 2 million property, your break-even is 2.521 million. What does this mean? It will mean that if you were to sell any, if you were to choose to sell your property at this price or below, you do not take any cash back. And in fact, we actually call that a negative sale. And if you sell any amounts above this price, then you get back cash. Okay? So the question is, then how? Right? So the question is, then how? And to me is this. Rent where you stay and buy where you invest. I've been saying this for a couple of years now. I know it's hard for you guys to embrace, but especially now, I think it makes a lot of sense, especially for younger couples or smaller families. Why do I say that? At times when you're able to afford to purchase a 3-bedroom condominium, but it does not mean that you need a 3-bedroom today, right? You could invest that money in a 3-bedroom condominium. You could lease it out, have someone else pay the installment for you. And in the meantime, you're able to rent a 2-bedroom because that's what you need at the moment, isn't it? And if you ever need to have a 3rd bedroom in future, it could be 3, 4, 5 years down the road, right? Then you can purchase that or rent a 3-bedroom at a time. So in between, you're able to save some monies and at least you be a bit more optimized in your resources, right? Or you could take the route of the BUC, where you take the advantage of the progressive payments, right? Invest that money that most of you have actually done with me, And when it's time to sell it, flip it off, and then reinvest that money again. And when it's ready to buy a property that you want and your dream home, of course, then you buy it at a time, right? If not now, you realize that if you were to do a detailed calculation, your cost of housing has grown significantly. Okay. Okay, next is something that maybe you have heard of, but sad to say, many have not taken action, especially if you are very comfortable and you know that, okay, as long as my CPF can pay off my monthly mortgage, I don't really bother that much. I don't even look at the numbers anymore. But I think you should, because you have to know your hard-earned money you're making every month, right? Your time you're exchanging to make that money has to go to a place that makes more sense. Yeah. So look into your present bank loan. And if you need to make a payment, especially those of you who are under the STIBOR rate, that was the previous rates, right? You are now paying, I guess, in excess of 3%. Yeah. And if SORA today is at 1.2, 1.5 something, yeah, and you can make that switch and save the difference. And even if you have to make a penalty, does that make more sense? Or if you switch it over to a fixed rate, does it make more sense? All right. Sit down and calculate and talk to a mortgage broker or to your banker for you to give you better advice. And if it makes sense, please go for it. Yep. And the next thing is for those of you looking to buy a property now, if you can afford it, take a shorter repayment period. Okay. What do I mean by that? Let me just show it to you. Now, so on my right-hand side here is what you can see. You're paying 6,700 over here, right, for 30 years. Okay. So immediately you can see the difference here. I'm calculating just on a difference of 22 years. Yes, the difference is about $1,400 a month. If you can afford it, go for it. You can see you have saved for yourself almost 300K in interest. Now, but where does the money go? That's an interesting thing, right? Here, as I explained earlier, more than 60% goes to your interest, only 40% goes into your principal. On this side, you can see that your interest is about the same, right? It's still 50 over 1,000, 50 over 1,000 here, is 40 over 1,000 here, next 5 years, 44,000, this is 43,000. Saving over $2,000-$3,000 is not going to make a lot of sense, all right? But where is the difference of this 97,000 here and 8,000? Right? You can see that the difference of about $17,000, it doesn't disappear, it's not being spent. It's actually paid back into your principal. Okay? So make a shorter repayment period. In fact, for those of you who are doing refinancing, and if you have good cash flow, right? Shorten your loan during this period, because do understand this. When the interest rate does fall to something which is a bit more manageable in future, and then you like it, right? It makes more sense. You can again at that time refinance and stretch your loan tenure. And to do that, you have to at least still be in employment. All right, you do a assessment again, and then you can stretch it again to be a bit more comfortable. All right. All right. I thank all of you listening in. This is all I have for you tonight. And if you have any questions, just shoot me a comment here. Then have a lovely night.